Hey guys, it's Hamish here, and in today's video, I'm going to be going through a full example of how you can use Warren Buffett's discounted cash flow method to value your businesses. Now, a while back, I made a video where I went through the strategy pretty briefly, and essentially you guys asked for me to do an updated version of this where I went in depth into a specific business and did a bit of a case study on how you can use this approach. And just to give a bit of background, I've been reading a lot about Warren Buffett over the past couple of weeks and months, and part of that has been reading his letters to the shareholders. I read all of them, and throughout his letters to the shareholders, he explains in bits and pieces how he values businesses. Now, I really highly suggest that you go check out that video first, because in that video, I also include what you need to do leading up to the valuation. And if you don't do those things, I'm not going to be talking about them in this video, but if you don't do those things before you get to the valuation, which I'm going to do in this video, then your valuation is going to be wrong and you're going to make really bad investments. So please go and watch that video first. I'll leave a link to it down in the description below, and I'll leave a card to it up there. It probably already flew by, but go check that video out first if you haven't seen it, and then come back here to see the full example where I'm going to be going through an individual stock. And that stock I'm going to be going through is Texas Roadhouse. Now, this is a business that I've been researching recently, so I thought it was appropriate to show you. So that's what we're going to be doing in this video. Make sure you leave a like if you enjoy this one, and let me know your thoughts down in the comment section below. But let's jump into it. Oh, also one more thing, guys. This video should be taken as being completely hypothetical. So this is just one example of me using the valuation. You shouldn't take the actual numbers that I talk about for this company as being correct. It's just an example and they're not accurate calculations. So make sure if you are going to be investing in any business, including this one, that you do your own due diligence. And of course, this is just my opinion. It's not financial advice. So if you do need personal financial advice that's appropriate for your personal circumstances, then please seek professional financial advice. So using Warren Buffett's method, there's basically three things that we need in order to do this valuation. The first thing we need is owner's earnings. The second thing is a growth rate, and the third thing is a discount rate. And in this video, we're going to go through all three, how I find them, how I use them, and then finally we'll do the calculation and see what number we come up with. So the first number is owner's earnings. And as I mentioned in the first video, we find this by taking the operating cash flow of a business on the cash flow statement and subtracting maintenance capital expenditure. Operating cash flow in 2017 for Texas Roadhouse was about $286 million. Just below that, we can see capital expenditure was $162 million. However, that capital expenditure number on this statement and in every statement of any company includes both growth capital expenditure and maintenance capital expenditure. And we just want the maintenance capital expenditure. So we've got to look into the annual reports and find out if they speak about capital expenditure in more in depth, so that we can separate the two and work out how much of that 162 million is for growth and how much is for maintenance. Now, if we search for capital expenditure on the annual report for Texas Roadhouse, we can see that they break down capital expenditure into two different categories. They break it down into new restaurants, development of new restaurants, so that would be growth because they're expanding the business. And then there's refurbishment of current restaurants. Now that's maintenance because they're maintaining the restaurants that they currently have. So that 52 million is the maintenance capital expenditure number that we're looking for. And now we can get owner's earnings by taking the operating cash flow, which was 286 million. We subtract the 52 million, and that leaves us with 234 million in owner's earnings. So next what we need to do is calculate the growth rate. So how quickly can this company grow that owner's earnings number into the future? And this is crucial because it's going to tell us the total amount of cash that this business is going to provide for us over the next 10 years. So you certainly don't want to rush this component, and your ability to calculate that specific growth rate, it's not a specific growth rate, but your ability to get close to the actual potential growth of this company is going to come down to your understanding of the business and the industry. So make sure you thoroughly understand the businesses that you're going to be investing in. From my personal research into this company, I calculate that an achievable growth rate for this company would be somewhere between 8 and 12% per year. And just to be conservative, we're going to go with the 8%. Lastly, what we need is a discount rate. And traditionally, this is going to be the risk-free rate that we can achieve. And what that is the yield on a 10-year treasury bond from either Australia or the United States. And essentially what we're doing here is we're making a comparison between a risk-free rate that we can get and the rate that we can get from this stock. Because if we can get a better return from taking no risk and just investing, lending our money to the US or Australian government, then we would not take a lower return from a risky business. So that's the comparison that we're making, and that's going to allow us to calculate the intrinsic value of this company. The yield on the 10-year US Treasury bond at the moment is 2.7%, and the Australian one is 2.2%. Now, I personally think that rates are going to be going up in the next 10 years. So just to be a little bit more conservative, we're going to use a 3% rate. So then all we have to do is we just plug those numbers into our calculator, and the calculator is linked down in the description below. But when we chuck in those numbers, what we find is that we get an intrinsic value of $2.84 billion. Now, this is the intrinsic value for the entire company. So we're going to be comparing that with the market capitalization of a company. Now, as you can see, Texas Roadhouse's market cap is currently $4.4 billion. So that means that not only is this company not priced substantially below its intrinsic value, it's actually above its value. So it's actually overvalued. Now, with this intrinsic value number, what it means is if we were to pay that amount and it grew at the rate that we expected, then we would make the exact same return as if we had just invested in a US Treasury. So if it's the same price as intrinsic value, we do not want to invest in it, because we could just put that money into a US or Australian Treasury and get the exact same return. So what we would want to do instead is to pay substantially less than intrinsic value. And by substantially less, I mean 75 to 85% discounted from the intrinsic value. So we'd want to pay probably somewhere in the ballpark of $1 billion. So I hope this video helped you guys understand the process a little bit better. The process itself is not that hard. What's difficult is understanding the businesses and accurately calculating that growth rate. You want to be very, very conservative, and you want to be very confident in it because you have a thorough understanding of the business and its industry. So if you have any questions, make sure you leave them below. I'll be answering your questions down there. Leave a like if you enjoyed this video and subscribe if you want to see more. But I hope you guys have a great day, and I'll see you in the next one.